A very good afternoon to our esteemed guest, Ms. Sakshi Gupta, our respected mentors, and all our members joining us today. I'm Meghna Bajoria, President of Global, and it is my absolute pleasure to welcome you all. We are living in a time of constant uncertainty. How is the ongoing wars reshaping the global economy? What lies ahead for oil prices and inflation? And what's next for currencies and interest rates? While all of us are trying to make sense of these shifts, who better than our guest today to help us navigate this complexity with clarity and insight? Before we begin, I'd like to briefly introduce our organization. Millennium Mams is a trailblazing nonprofit that has been empowering women through financial literacy for more than 3 decades. Our visionary mentors, Mr. Vishnu Dhanuka and Mr. Sanjay Bhuvania, have impacted the lives of over 12,000 women. Today, our presence spans over 65 cities in India and across 22 countries worldwide, a testament to the power of purposeful learning and community. Our investment philosophy draws deep inspiration from Mr. Warren Buffett. In 2019, we had the honor of representing India at the Berkshire Hathaway AGM in Omaha as the country's largest women investor group. At the heart of our learning community, our speaker series brings thought leaders from around the world to spark ideas, challenge perspectives, and connect us with real-world insights. It is my privilege to introduce our guest for today, Ms. Sakshi Gupta. Sakshi is the Principal Economist and Vice President at HDFC Bank with over 15 years of experience in the financial sector. She leads the Treasury Research Team at the bank and specializes in Indian macroeconomics, global currencies, and interest rate trends. Her team has been consistently recognized amongst the top forecasters by Reuters and Bloomberg. She has previously worked with HSBC and CRISIL and is a published author and a regular voice across leading media platforms. She has also been a guest speaker at various business schools across India and is involved in conducting extensive training courses at the Ministry of Corporate Affairs. It is my privilege to invite Ms. Sakshi Gupta to address us on the topic India Outlook Amidst Global Shocks. This will be followed by a Q&A which will be moderated by our Mumbai chapter president, Sweta Sachdev. Over to you, Sakshi.
Thanks a lot, Meghna, and thank you to all of you for this wonderful opportunity. I'm extremely excited, to interact with all of you today. It's going to be a little difficult for me to follow up the very eloquent, thoughts that we heard from Sir earlier, but I will try and do my best. Hopefully give you, not completely gloomy picture of what's happening globally, but try and balance it out and talk to you about, what we think is working for the Indian economy and what, as investors, you should perhaps be cautious about. So if you could give me a second, I'm just going to share my screen. Right. I hope it's just going to take a second. Yeah. Meghna, is it full screen?
No, it's visible, but you can put it on the full screen mode. That is not showing us yet.
Is it? Okay, sorry, just a second. Let me just try again. I have.
Yeah, now it is. Yes.
It's fine.
Perfect.
Yeah, okay. Great. Right. So, of course, the backdrop that we are having this discussion today is, of course, very interesting because I think last 12 to 18 months, there has been a lot of volatility globally that has also impacted, Indian markets, what's been happening in our economy. I think just to give you some context, of course, last year was all about US tariffs, and how, initially the mood around the Indian market was very positive because we were viewed as somebody being very close to the US, and it was expected that we will come out with a favorable trade deal. However, somewhere around May or June, at the same time where we had our altercation with with our neighbor, I think things started becoming a little bit more uncertain and volatile from a market perspective when we're looking at the currency, the banking system liquidity, interest rates, etc. Of course, being hit by 50% tariffs for most part of last year had an impact on, financial markets, the kind of flows that we saw from foreign investors, etc. And just as when, this February, when we got a trade deal, just as when things were beginning to improve, from a sentiment perspective, of course, now we are hit with a completely new shock. I think why I'm talking about this is that uh, uh, increasingly over the last 3 or 4 years, there has been one shock after the other, right? A new global event that is happening that has led to a lot of volatility. Now, the good news is that despite a number of these shocks, time and again, Indian macros have kind of shown that there is this underlying resilience that is there in the economy, of course, supported by both the central bank as well as the government. So I would say that that's clearly good news, and I will talk about some of these factors in my presentation. Secondly, I think that we should prepare ourselves for this being the new normal. Right. So if it is not some geopolitical tensions where the market then starts thinking about the AI trade, if it is not the AI trade, will markets start worrying about what happens in US midterm elections. If it is not that, is there worry around government debt levels or private credit, in the US? So I think there is this constant volatility that we kind of have to live with, is my best estimate over the coming years. In that context, let's specifically now boil down and talk about what's currently happening, right? I think as we speak today, we've still not seen any significant move or de-escalation in the situation between US and Iran. End of March, we were thinking that perhaps this goes on for another 1 or 2 weeks, but it's been a month since then. There's been a ceasefire. But the problem is that the Strait of Hormuz, which is extremely critical for a lot of commodity supply, and not just oil, but a lot of other commodities, still remains closed. And therefore, we are forced to work under different scenarios at this point, right? So, to give you a perspective, the disruption from the Strait of Hormuz being blocked is actually one of the highest that we have seen over the last 5 decades. And if we map the peak hit to supply since the 1970s, this is the most severe hit to supply that we have actually seen. Um, Clearly, that means that we have to revisit what we are thinking about how oil is going to go, moving forward. Now, we started the year thinking that, look, the commodity market is very comfortable. That is pre-war. There's a lot of oversupply of oil in the market, and therefore oil prices are a non-issue, right? So oil prices at best average somewhere between $60 to $65 per barrel. We have now moved that assumption upwards, where we are saying that, look, now the best case or the base case we are working with is that oil prices average around $85 per barrel. This is assuming that, let's say, over the coming weeks, the conflict resolves. Oil for the next 3 or 4 months, even in that situation, will continue to trade between $80 to $100 per barrel, because there has been a significant impact on energy infrastructure within the West Asia region. So it will take time for all that supply to come back into the market. So I think for the next 2 or 3 months, assuming that this conflict resolves even tomorrow, I think oil prices will continue to face some pressure. And it's only in the second half of the year where finally, supply and demand will kind of balance out, and you might see oil prices move below $80 per barrel. So, of all the things that I'm going to speak today in terms of RBI or inflation or the rupee, this is the base assumption that we are making. If this does not hold and we find ourselves in a more adverse situation, right, and it is a continuation of what is going on currently, I think we'll have to kind of rework and rethink our macro projections completely, because I think with oil above $100 per barrel on average, I think it completely changes the metrics in terms of our growth, inflation, and interest rate outlook. Uh, this chart is just, I was talking about supply and, how important the Strait of Hormuz is. Of course, we have to remember that this is not just about oil, but a host of commodities that are being influenced by the strait being blocked, right? From everything from sulfur to aluminium, a lot of commodities are impacted because this strait is closed. Secondly, of course, because there's been a supply disruption, we've consequently seen an increase not just in oil prices, but we've started seeing the impact also flow through, and particularly for India's case, for instance, in the fertilizer segment, right? Combine this with the freight cost going up. I think if you look at our import basket, then that's had an impact on, import costs for most commodities that we are getting into India. So clearly, from a trade perspective, this is a pressure point that could continue, as I said, till the time that the strait opens up. So let's, so we've spoken about, okay, what's happening in the commodity space, how important the strait being closed is. Let me now just talk a little bit about what does this mean in terms of growth, not just for India, but global growth, and how the market is currently viewing the impact of this conflict. So what is happening is that there is clearly a divide between oil exporters and importers, which is also very reflective in how currency markets are moving or equity markets are moving, right? So, for instance, the US equity market seems to have done much better than, let's say, if you compare it to, an emerging market, which is a large oil importer. So we have Indonesia, we have India, there is, of course, Thailand. So there are a number of economies that are hit much more in terms of the impact on growth and consequently then earnings going forward. While for oil exporters like the US, I think this turns out to be slightly less damaging to that extent. And I think this is very clearly visible in, these are IMF forecasts, the most recent forecast, where you can clearly see this being picked up in the downward revision to growth that the, IMF is making, where for the US is pretty much flat. And the expectation in the market seems to be that US growth will continue to hold up. But the kind of revisions that we are now beginning to see for some of the other countries in the Asian emerging market space are much more severe. On the flip side, while this is a downside risk for growth, I think what started happening is that it is also inflationary in nature, because we spoke about so many of the commodities where prices are going up. And across the world, you see now that there are upside risks to inflation compared to where, most central banks or governments were estimating inflation at the beginning of the year. So the impact is flowing everywhere from the US to China to India and, other emerging and Asian economies. What this has ended up doing is that you've also seen a reaction in the bond market, where bond yields have started going up because market is concerned that with inflation going up, central banks across the globe are going to start increasing interest rates. And just last week, we had three very, very important central bank meetings. So the US central bank, which was expected to cut the policy rate this year, is now expected to remain on hold. The European Central Bank and the Bank of England have hinted at the fact that, look, maybe we start looking at rate increases as soon as June or July. Right. So market is estimating that the European Central Bank might hike rates this year by 3 times before we reach the end of 2026. So the bottom line here is that with inflation risk going up, I think the bottom on interest rates across markets is now behind us. So we have been in this cycle of lower interest rates globally, as well as in India. I think that scenario is now behind us. For the RBI, while we, and I'll talk about the RBI in detail a little bit later when I talk about inflation, but my view on RBI is that while right now the market is thinking that maybe the RBI starts increasing rates, I think for us it is a little bit premature to price in any rate increases. My estimate would be that the RBI remains on hold for 2026, and because it has to kind of balance both the impact on growth and inflation, right? So for us it is not just inflationary, but this conflict could also play out in terms of having an impact on our growth. So now let me get into the India story and let me talk about how I'm thinking about India, right? So, and a good starting point would be to think about what happened during the Ukraine-Russia war. That was 2022. It, in some shape and form, it was a similar shock, where you did see oil prices move up quite significantly. Just to give you some benchmark, in 2022-23, oil prices averaged close to about $95 per barrel. That was also the time when we were just coming off that pandemic surge and peak that we had seen. So post the opening up effect, there was a lot of growth in the economy. So FY22 growth and consumption were very, very strong. Inflation was very high. And then as we moved into FY23, RBI started increasing the policy rate because higher commodity prices led to a further increase in inflation, right? So I think that in some shape and form, this particular shock can seem like the Ukraine-Russia war, and that is why I think the market is thinking that this time again inflation is going to increase and the RBI might raise rates. Um, uh, Now, let me tell you how this can actually end up being different, right? So, I don't think that this will completely mirror what happened in 2022, 2023. The reason for that is that, of course, yes, there is an impact on inflation. And once that inflation is passed on to consumers, there can be an impact on, household consumption, etc. But at this point, I'm also worried about the fact that if there is an impact on physical supply of energy products. Right. So if we are short on, let's say, LPG, if we are short on oil, if this disruption continues and the physical supply becomes a problem, then this can also turn into a shock that is similar to the pandemic, where severe supply disruptions tend to have a much more non-linear impact on growth rather than just being concentrated and being a price shock. So this is the exact dilemma because of which I think the RBI in its April policy decided that, look, it's too soon for us to start talking about interest rate increases. We still have to worry about how this plays out and whether there's an impact on growth, which can be extremely non-linear, in which case we might actually have to cut rates or be more supportive of growth. And that is why I believe that talking about interest rate increases this year is still too premature. Now, let me, just make a couple of points on the good news for India. Right. I think I started my talk today by saying that, look, we've had a number of shocks, but we sometimes forget that there's a lot of resilience in the Indian economy. Right. And going into this shock, the Indian economy starting points were actually very, very good. And one of the starting points that I'm showing you here is what was happening to, consumer demand in the economy. So you had periods of, rural demand doing well, urban not doing well. Then we saw urban demand doing well, but rural was coming off. So there's been a lot of fragmentation in demand over the last 3 fiscal years. Encouragingly, over the last 3 quarters, after we had interest rate cuts from the central bank, and more importantly, the GST rate cut that came in, we started seeing that both rural and urban demand started picking up. Even in the months of January and February, a lot of indicators that we track were telling us that there was continued demand momentum in the economy. Now, the bottom line here and what this tells me is that even if inflation goes up a little bit, household balance sheets tend to be better positioned at this point. Compared to maybe where we were, let's say 2 years ago, where there was a lot of fragmentation in how rural and urban demand were moving. So I think if this shock is contained and limited, households may be able to kind of absorb this shock without reducing demand to a significant extent. Um, of course, this is just data on what's happening and reiterating my previous points, because you've seen healthy growth in the auto sector, and that's a very, very important leading indicator for economic activity. You've seen sales continue to inch up across segments within the auto space. The second thing that I think is positive for us is that we've also, despite the fact that there's been a lot of news around, AI and AI replacing jobs, etc. If we look at some of the labor market indicators, especially in the urban segment and the formal segment, we've actually seen an improvement in hiring conditions over the last 3 or 4 quarters. A lot of this is being driven by, of course, you have your GCCPs, which is your global capability centers. We've seen a lot more hiring that is happening in services like travel, real estate, etc. So I think the underlying story on the job market might seem a little better. At least that is what the data is telling us, that it is slightly better than the common narrative, around AI that is currently floating around. Uh, now, let me get into inflation and RBI, right? So we spoke about the Ukraine-Russia war. And here in this chart, you see where inflation was during that period of time. So going into that war, inflation in India was already at about 5.5%. Now, the central bank targets 4% inflation with a tolerance band of, 2 to 6% on either side. With inflation being so high at that period of time, of course, the energy price shock further pushed up inflation in that year, and therefore the central bank was forced to increase interest rates. This time around, the situation is slightly different. Why? Because over the last 12 months, inflation in India actually has been extremely low. So whether I look at wholesale inflation, which is what the inflation that producers face, or I look at retail inflation, which is what households face, the starting point of inflation is just about 3.2%. There have been a couple of months in the middle where inflation was actually below 1%. So I think the central bank has enough runway before it decides that, look, inflation now is much higher than my tolerance band, and therefore I need to turn towards interest rate hikes. What we are currently estimating is that, look, in our base case, if this conflict resolves in the near term and the oil market settles down, inflation could average somewhere around 5% for FY27. Of course, with oil at 100, oil at 110, I mean, we can keep increasing this number, by 20, 30 basis points, depending on the extent of the impact. Uh, uh, just a risk on inflation that I must point out is that this does not completely factor in any sort of disruption that might come through because of El Nino. Right. I think that we are so focused today talking about West Asia and oil prices. I think a bigger risk in my mind right now is also the El Nino. The Indian Meteorological Department is saying that, look, this year monsoon is going to be below normal. I think that has implications for how, rural income, rural demand, agriculture output perform over the coming quarters, and that remains a risk. It also means that, there could be greater price volatility, particularly in perishables and food items, that could start being a further upside risk to this inflation forecast. So that is something that, it's difficult to predict how weather related events would play out, but that clearly is an upside risk to the forecast that I'm, currently showing to you over here. Um, So let me just talk about a little bit from the current account perspective. This is the last thing, and then we'll move into, questions and your thoughts around it. So let me just talk about the rupee. Of course, the rupee has been under constant weakness and pressure, over the last 12 months, as I said. We did see some relief in February after the trade deal with the US was announced. But again, given that we have a lot of dependence on oil, this remains a very big risk for the rupee. I think from here on, of course, the central bank will come in, and they've been trying to manage volatility in the rupee. But clearly, they are not, from what I understand of the RBI and my interactions with them or their public comments, I don't think that they are there to target any particular levels or put a line in the sand in terms of, okay, the rupee cannot cross 95, it cannot cross 96. I don't think that they are coming in, with that perspective. Yes, they will come in and smooth out volatility, but till the time that oil prices remain elevated, and given our current account deficit situation, I would say that the balance of risk is stacked against the rupee, and for rupee to weaken further from where we are today. Today there's some news around the fact that if this conflict continues, the central bank might be, there are sources that they're saying central bank might explore options to attract dollar flows, right? Similar to what we saw in 2013, where they had, come out with a scheme to attract NRI deposits, etc. So, we don't know if we are there yet, but my sense is that if the situation doesn't improve, I think we should be prepared for the central bank to come in and bring in more out of the box measures to attract capital and stabilize the rupee. Clearly, they will not be okay with runaway weakness or depreciation, in the rupee. So I'll just like to stop here. These are just some initial thoughts on the economy. Of course, this is, as I said, uh, the good, so the how I would summarize it is that, yes, this is a big, I think, risk for us when we are thinking about macros, and the rupee and financial markets. But I think we should not lose sight of the fact that we also are at a very good starting point from a macro perspective. And there, last year there was a lot of anxiety around tariffs, etc. But India still ended up growing at about, 7.6% real GDP growth in FY26. So there can be, I would expect that the government and the RBI would come in and cushion the impact that we are facing from these, tensions currently, and try and minimize as much the impact that we see on, domestic growth. So I'll just like to end here, and happy to kind of open this up, for more detailed conversation, and happy to answer your questions.
Yeah, thank you so much, Sakshi. And I'd like to invite our Mumbai chapter president, Sweta Sachdev, to take the Q&A session forward. Thank you.
Yeah. Thank you, Meghna. Thank you so much, Sakshi. I think your presentation was very sharp, very insightful, and we can now join the dots, from be it oil, commodities, inflation. I think that's what we were looking for, to just understand the whole flow. I'll start with my question, Sakshi. I know you spoke about fertilizer segment and the cost of fertilizers. My question is around this. We're saying now we are procuring fertilizer at a very high cost. and we still provide subsidies though. So how do you think, with other factors as well, putting pressure on the finances, how will this impact our fiscal deficit, Sakshi?
Yeah, you're absolutely right. I mean, the point that you bring up, so it is not just about the fertilizer subsidy that can go up. Maybe we've already seen the impact play out because the government cut excise duties on petrol and diesel. We'll have to see, whether they increase the price of petrol and diesel with the, elections now behind us, whether that increase kind of comes through in the next couple of days. But, clearly from a fiscal perspective, this adds to the pressure in terms of the fiscal math. Now, the way I see things is this. In February, if you look at the budget numbers, the government actually did not go ahead and commit to extreme fiscal consolidation. Right, their fiscal deficit target was not pointing to any major cutback in expenditure. Also, their assumptions on tax growth, collections, etc., were extremely conservative, right? Because nominal growth that they've assumed is close to 10%. And now with this inflation number that I just showed you, or what the RBI is estimating, nominal growth for FY27 will be much higher, right? I think it will be above 11%. So I think that in itself will provide some cushion to the tax collection numbers that we start seeing. That is one. Secondly, we'll have to look at the RBI dividend, because that's another big game changer for the fiscal math, right? With the amount of intervention that the RBI has already done, there is a fair chance that the dividend that is transferred to the government can also be higher, right? So there are some cushions in place. I think that if the government has to increasingly divert resources towards subsidies to manage this price shock, or to come up with credit guarantee schemes, etc., I think it will be essentially a strategy where they start diverting resources from other expenditures towards servicing subsidies, etc. Now the risk there is that if if they find themselves in a situation where they have to cut back capital expenditure because your revenue expenditures and subsidies have gone up, I think that tends to have a negative feedback loop on growth, of course, right? But that is something that they'll have to manage. I think that just looking at the performance that this government has done in terms of managing the fiscal situation, at least at the center level, I would say that they are very committed to cleaning up their balance sheet, to maintaining fiscal consolidation. And therefore, at this point, given the fact that I told you there are offset in place, they can always rationalize expenditure in other places. I am not expecting fiscal slippage, at this point. So I think we are still just in the second month of the fiscal year. And although this is a risk, I think it can be managed.
Great. So you're confident that the government will take care of this?
Hopefully, yes.
Yeah. Great. And we'll move on. We have a lot of members waiting to ask questions.
Sure.
I'd call upon Pooja Narang from Hong Kong for her question, please.
Hi, Sakshi.
Hi.
Sakshi, my question these days, many economists seem to feel that domestic consumption is becoming more important than exports, which used to be a major source of growth for our country. What are your views on this? Is it fine, or does there need to be a balance?
Look, as an economist, I would say that yes, there needs to be a balance, right? So I mean, that's what my view would be. That look, you need to kind of not just rely on domestic demand, but you also need to kind of there's a large external demand that you kind of can cater to, and usually does lead to a lot of productivity gains, etc., right? So from a growth perspective, or increasing your potential growth, I think that would be a fair strategy to balance it out. That being said, I think given where things are today globally, right, and how things are moving in India, I think domestic demand has become increasingly important. There is no doubt about it, right? also in the context of the fact that if you look at how the global economy has been moving and how policy globally has been set, especially since the 2008 financial crisis, right? I think that was a turning point where you started seeing globalization as a concept kind of lose its shine. And since then, you start seeing a lot of economies beginning to look inwards and try and focus towards domestic markets is something that we've seen time and again. So in that context, of course, yes, domestic demand is extremely has become extremely important. I think just some changes that I have noticed over the last couple of years in India is that I think there has been an effort towards pushing exports and tapping into the external demand story, right? So, yes, we are trying to become self-reliant, and yes, there's a lot of focus towards supporting domestic consumers. But at the same time, if I pick up stories like electronics, and what's been happening in that space, and all the measures that have been taken both by center and state governments to kind of push that piece, right? I think that's phenomenal. If you and also the amount of FDI that we've ended up attracting in that space, I think that is very encouraging. Also the recent efforts towards getting into bilateral trade deals, with various countries, I think, of course, is also positive. So hopefully the strategy going forward would be a mix of both. But I agree with what you said earlier, that at least seemingly in the last 2 or 3 years, of course, domestic consumption has become very important.
Absolutely, yes. All right, thank you so much.
Great, thank you. Can I call upon Manjari Karodia Kapadia from our Mumbai chapter?
Good afternoon, Ms. Gupta. Thank you for a very interesting presentation and keynote address. It's been very informative. My question to you today is, following Charlie Munger's inversion principle, what, in your opinion, is the single biggest downside risk for India achieving the 6.5% to 7% growth trajectory today?
Well, look, I think that we shouldn't. So first, in my opinion, for the size of our economy, we should actually be aiming for growth that is closer to 7.5%, 8%. Right, 6.5%, 7% is something that perhaps is pretty much achievable. For us, because we are a large economy, there are various moving parts. When I think about the biggest downside risk, and this is, of course, in the near term, I spoke about oil and all these are cyclical factors. Look at the central, consumption demand goes down, or there are problems with capital expenditure, but these are all cyclical factors. When I'm thinking of a more, medium term trajectory, to my mind, I think for India, employment and skilling at this point is actually the biggest downside risk. I think we are already, since I became an economist, since I have been studying economics, I have always been told the story that India has a demographic dividend and we have a large middle class, etc. However, a lot of those stories haven't really panned out. Right. If you look at what's been happening to per capita income, if you look at employment level, if you look at skill levels, or you look at labor productivity, it's been pretty much stagnant over the last 2 decades for India. Right. I think that was a low hanging fruit for us that didn't kind of materialize the way it should have. And I think if we are unable to solve this problem in an environment where AI is going to become dominant and manufacturing is already becoming more and more capital intensive, I think absorbing our growing labor force and skilling people, to work in the formal sector or the services sector, I think is the biggest downside risk. It is the biggest downside risk for us to remain a middle income country, for per capita incomes to be lower. I think for labor's bargaining power and be able to bargain for higher wages, so to say, right? Because everything is becoming so much more capital intensive in nature. So in my mind, I think that is the biggest policy or economic problem that we currently are facing. There are no easy answers, of course, for this.
Thank you so much.
Thank you.
Thank you.
Can I have Swati Chaudhary from our Calcutta chapter, please?
Good afternoon, Sakshi. We are very bullish on the Indian economy, and within that, we prefer the banking sector. And within banking, HDFC Bank stands out. Your view on this, please.
Yeah, no, I'm from HDFC Bank, so I will say very good. I have no other view to give you on this, but yeah, no, but on a serious note, like, I will not comment on the bank, etc. But look, I just want to say something from a more medium term perspective, right? So the government keeps talking about Viksit Bharat. We just spoke about what ideally should be India's potential growth, that we should grow at 7.5%, 8%, etc. Now, a lot of this cannot be achieved without the banking system, kind of growing further, right? With credit growing further. I think a lot of this will have to be financed. And I think that the banking system in general will play a bigger and bigger role in kind of getting us to, higher per capita income levels or higher GDP growth levels. So, yeah, I'm also bullish on the banking system.
And what about HDFC Bank?
So a banking system means HDFC Bank, everything. I don't want to personally comment on any particular company, etc. But yes, in the broader context, if you think that, and I truly believe that, and we've done some number work around this, for the banking system, the amount of growth in assets or AUMs that would have to come in, the kind of increase in credit, assets, etc., that we will have to see to achieve higher growth potential, etc., does make me quite optimistic about this space.
Thank you.
Sakshi, I'm going to ask you, in one of your recent posts, you mentioned that fear is outpacing fundamentals right now. So
Yeah.
for retail investors watching India right now, which one fundamental indicator should we track to cut through the geopolitical noise?
Well, I mean, that's difficult. I mean, to think of just one, I think, indicator. I wouldn't say one indicator, but I think that there are a couple of things that I would be watching out for very closely, right? I think on the macro front, the first is, of course, to look at what is happening to, inflation. To what extent, and of course, producers are already facing higher price pressures. I think what I'm interested in is what is the kind of pass through that you start seeing at the retail level. So what is it that you and I start paying for everything that we are buying, from consumer durables to non-durables? So that is clearly one thing that gives me a sense of what's happening to household balance sheet. The second indicator that I would watch out for is, when is that point where there is any turn in sentiment towards India in terms of the portfolio flows that are coming in? Because if you look at the equity market, of course, with a lot of domestic investor interest, our markets have kind of held up relatively, right? But we have seen a lot of outflow on the FII side, both on the equity as well as debt segment, right? So I think a change in that segment and change in that flow is something that I will track closely, because that has implications for, the rupee, the equity market, what the RBI is doing, banking liquidity, everything in the system. So, I mean, yeah, two indicators, not one, but these are two things that I would watch out for.
Thank you. Can I call upon Ekta Jain from our Delhi chapter?
Good afternoon, Sakshi. How are you?
Good afternoon. I'm very well. How are you?
Good. So my question is that which is one key risk related to India that you think share markets are currently underestimating?
I think that the oil risk, I'll tell you why. And this is not underpricing just by India, but I think some of the other markets as well. Uh, Today on our screens, the oil prices that we see is somewhere around $105, $108 per barrel.
Yes.
But if you look at contracts in terms of physical supply, the price of oil is actually much higher, right? So it's closer to $140, $150 per barrel. The market currently, so the price that we see on our screens is future price for oil, right? The physical trade that is happening on oil is actually at a much higher price. Now, this tells me one thing, that the market today feels that this conflict will resolve itself. And that is why oil is still below whatever, $110 per barrel, and it is not shooting up to 130, 150. And at the beginning of my slides, I showed you, the kind of peak supply hit that is currently being witnessed because of the Strait of Hormuz being closed. At this level of supply hit, oil prices should have been much higher. They are clearly not. So I think there is some amount of underpricing. And I would say that that's one of the biggest risks at this point.
Thank you.
Can I have Nidhi Kanoy from our Mumbai chapter?
Hi, good afternoon, Sakshi.
Hi, good afternoon.
Sakshi, you've talked about 7.5%, 8% growth and couldn't agree more. So if you were to advise policymakers today, which one structural reform would you say would have the highest payoff for India's growth at this level?
Well, look, in some shape and form, the government has been trying to do a couple of reforms. Okay, in the manufacturing space, we've had PLI, etc. I would say that kind of replicating the success of the PLI within the electronic space to other sectors is perhaps something that needs to be looked at and focused at, right? Because that's the only sector where the PLI has actually been successful. We haven't seen a similar story anywhere else. Secondly, as I said, I mean, the government has come in, we've had the new labor codes, etc. But we have the, national education policy. There are efforts towards skilling. I still don't think that we are there yet in terms of the policy effort that is being made and the actual expenditure that we have. So the amount that India spends on education is actually one of the lowest when you compare to a lot of our peers, right? And I think, yes, we've spent a lot in building roads and highways, but perhaps now is a good time to switch up that strategy and start diverting resources towards both healthcare as well as education. I think as a percentage of GDP, we should be spending at least, 4 to 5%, if not more, on these particular sectors, because given the fact that I said earlier that labor supply is clearly one of the biggest problems, that we have. So yeah, I would say these two things.
Okay, thank you so much.
Our next question from Nidhi Jindal from our Delhi chapter.
Hi, Sakshi. Thank you so much for your insights. And you just spoke about rupee depreciation and RBI's role in this. I feel that RBI has been trying fairly to keep the rupee stable. But do you think this has come at the cost of letting the market decide its value freely, or it has actually helped overall economic stability?
Look, okay, so the RBI is, when we had the new governor come in, so before that, if you remember, when we had Governor Das, there was a time period where the rupee was moving very, very tightly. There was hardly any volatility in the rupee, right? With the new governor coming in, clearly his thinking seems to be that, look, the rupee is a function of markets, right? And which is desirable from a long-term macro perspective. However, we will not tolerate excessive volatility in the rupee, which is a result of speculative positioning. So we have seen periods where there has been overshooting and a lot of weakness in the rupee, which was not perhaps desirable or did not mirror our macro fundamentals, right? So I think from a policy perspective, given the fact that we are trying to push our exports, we want to be competitive, it does make sense for the rupee to align with market fundamentals and see gradual depreciation over a course of time. But of course, very sharp volatilities in the rupee can actually be very, very damaging.
Yeah.
Because they can be like self-fulfilling prophecies, where if today rupee is moving towards 95, I think just a couple of weeks ago, I started hearing everywhere rupees moving to 100, rupees moving to 100. And we were at 94 at that point, right? And then it becomes like a self-fulfilling prophecy where the market drives it there. Now, the RBI stepped in and said, no, that's not where we are headed, or speculative positioning is something that will not be tolerated. So I think that they've been very, very good at managing the rupee volatility. And I don't think that the market is dictating completely, where the rupee is moving, if those expectations or those factors are completely not aligned with fundamentals.
Thank you so much, Sakshi.
Can I have Pooja Agarwal from Calcutta?
Good afternoon, Sakshi. Sakshi, according to you, how long can India's strong fundamentals absorb the West Asia conflict, US tariff pressures, and now the El Nino effect all simultaneously?
Well, I mean, that's exactly the kind of risk that, I've alluded to, and it's a very, very difficult situation. I don't think it's fair to make an assessment of how long we can absorb this. Look, we are at a good starting point, of course, right? So if you look at corporate balance sheets, if you look at the banking system, if you look at household balance sheet, you look at the government's balance sheet in terms of where it stands, in terms of our debt levels and fiscal deficit, etc. I think we have very, very good starting points. Right? It is very difficult to say that, look, we can absorb this shock for 2 months or 1 quarter or 2 quarter, because it also depends on the nature of the shock. So as I said, if this is purely a price shock, I think we are very well equipped to kind of absorb this and come on top of it by the end of this fiscal year, right? So I don't think that that's going to be a big problem. In terms of if this becomes like, more of a supply disruption and physical supply disruption, I think then the impact can be more non-linear. Secondly, you talked about El Nino. Let me also, since I, talked about this risk, let me also say that while El Nino is a risk, we have to at the same time remember that reservoir levels right now are very, very good. Supply of food that is coming into the market over the next 6 months is going to be healthy, because that is all supply from the winter crop, right, that is coming in. Stock levels are also very, very healthy. So it is not like we will suddenly see El Nino this year, and over the next 2-3 months there's going to be, rural demand will completely crumble up. I mean, we'll have to see the impact, and it only plays out with a lag, given that there are also offsets that are in place.
Okay.
Thank you so much.
Can I call Shweta Singhal from Calcutta for our last question?
Hi, Sakshi. Sakshi, my question is on a different side, like on the cybersecurity front. What kind of risk is there from anthropic mythos on banking?
Yeah, I mean, this is something that I think the FM also spoke about. I'm not an expert, honestly, on AI. It's something that I'm now teaching myself as well in this whole universe. But this is something that finance minister's comments are very telling, right, of this, that this is clearly something to be taken very seriously. Not just in the near term, but I think as a strategy going forward. So not just the banking system, but in general, I think now businesses, corporates, the banking system, etc. I think increasingly I see this shift where there will be a lot more that you will have to do in terms of, risk assessments, appropriate risk assessments, and investing towards kind of really building your systems, point by point answer specifically to how this risk can play out. But I completely agree that this is, next 5 years, there's going to be a change in strategy, and there's going to be a lot more focus on de-risking across corporates, is my sense.
Thank you so much.
Meghna, I think we have time for one last question, one more?
Yes, we can,
I
Shweta.
call Krishma Shah from Mumbai chapter for...
Hi, good afternoon, Sakshi. You did mention that domestic demand is important. I want to know, since the consumption trend is very unevenly spread between rural and urban, how does HDFC's lending strategy, how does the strategy work? Plus, affecting the risk outlook and the economic outlook, how does the lending strategy, basically, how do you define your lending strategy?
Yeah, I'm sorry, I would not be able to comment on the bank per se. I'm not the appropriate person to make comments on the bank's internal strategy. But I would just, in the context of your question, let me just say a couple of broader points for the economy, right, or for the banking system, right? So you're right that there's a lot of volatility or uncertainty around consumer demand, right, in the system. There are two elements. One, the urban side is completely different from, of course, the rural side. On the urban side, of course, we saw that there was, in the banking system, there was this increase in unsecured loans, right, where the RBI came in and then intervened, etc. However, now in the present situation, if you look at who are the borrowers, in terms of the unsecured portfolio for the banking system, I'm not commenting on the bank, HDFC Bank in particular, you will find that a lot of the borrowing is happening in prime or above prime customers, right? So, of course, some of the problem around the unsecured portfolio was also with, a lot of other players coming in, right? So it was not just banks, but a lot of other intermediaries and other players that were there in the market, with a lot of digitalization, etc. Of course, the ease of access. So, of course, it's very important. It's a, individual bank decision to kind of be risk averse and assess some of these risks at the system level. I don't see this to be a problem for the banking system, right? I think that if you look at non-performing assets for private sector banks, they are at decadal lows. Balance sheets are looking extremely healthy and very, very good, right? For the rural sector, of course, the RBI you have your PSL guidelines, etc., that guide a lot of your lending practices within the, rural segment. But there again, you have a lot of players that are there in the market beyond. But there, and again, I don't see a noticeable increase despite the uncertainty around consumption or volatility that we have seen. I don't see an increase in asset quality at this point, right? Again, from a banking system perspective.
Thank you.
So we see a lot of positives coming from you, which is great. I'd now like to call upon our East Zone President, Poonam Singhal, for the vote of thanks, Sakshi.
Thank you, Shweta. And thank you, ma'am, for giving us such an inspiring and insightful session. It was a great learning experience. On behalf of Millennium Mams, I would like to extend my heartfelt thanks for giving us your valuable time. It was truly an honor to have you with us, a leading voice in India's financial and macroeconomic landscape. You brought immense value through your deep insights and rich experience across banking, policy, and global markets. Sakshi, your session offered us a clear understanding of key areas such as currencies, interest rates, and broader economic trends. Your ability to simplify complex economic concepts and connect them with real-world implications made the sessions both engaging and enlightening. The perspectives you have shared will undoubtedly help us to think more critically about the evolving financial environment. Your insights on inflation, job market conditions, rupee volatility, and the oil supply were some key takeaways that I'll keep with me. We are sincerely grateful with your wisdom and willingness to share your expertise with us. Thank you, Sakshi. On behalf of everyone present, I extend my deepest thanks to our mentors, Vishnu Dhanuka sir and Sanjay Bhuvania sir, providing a platform where learning never ends. Thank you to all our mams who have engaged and come here in such great numbers. I'm truly grateful to each and every member. Thank you once again, Sakshi, for such an insightful and inspiring session.
Thank you.
Thank you. Thank you so much.
Thank you, Sakshi.
I'm very humbled. I enjoyed myself.
Thank you so much, Sakshi.
Yeah. Thank you.
Thank you.
Thanks,
Thank you.
everyone.
Thank you. Thank you.
Thank you.
Bye.
Thank
Bye.
you. Thank you.